I'd use this stock market dip to buy Rolls-Royce shares. Rolls-Royce shares are falling again, but they are hardly alone in that. Almost every other stock is falling right now. At The Motley Fool, we believe a stock market correction like this one is an opportunity, rather than a threat. It's a great chance to pick up our favorite stocks at a reduced price. Inflation is coming. Inflation is out of control, and people are running scared. But right now there's one thing we believe investors should avoid doing at all costs. And that's doing nothing. That's why we've put together a special report that uncovers 3 of our top UK and US share ideas to try and best hedge against inflation. And, better still, we're giving it away completely free today. Click here to claim your copy now. We believe in long-term investing. Once we have bought a bargain stock, we aim to hold for years. Rolls-Royce stock has taken a beating. Can it recover given time? This FTSE 100 stock has fallen far. Rolls-Royce had a dreadful pandemic. As the world locked down and airline shares tumbled, the FTSE 100 jet engine maker suffered spectacular collateral damage. It generates revenue from the accompanying maintenance contracts, which are linked to miles flown. No flying means no revenues. Bargain hunters swarmed over Rolls-Royce shares. Some banked a quick profit, others are sitting on a loss as the oil price rockets, driving up airline costs. The Rolls-Royce share price is down almost 10% in the last week. Over 5 years, the shares have lost 3/4 of their value. Investors who bought previous dips have had to wait a long time for vindication. Yet still they swarm. Even though the dividend has gone, respected Chief Executive Warren East is leaving and Brent crude has hit $123 a barrel. China has lifted COVID lockdowns. But we could still get a third wave of the pandemic, which would hit flying again. Inflation is another threat. We have yet to see whether Rolls-Royce has pricing power, and can drive up its maintenance charges to match. Buying Rolls-Royce shares during the current stock market crash is a big risk. Yet there are grounds for optimism, too. Morgan Stanley reckons its stock has been underpriced, as its earnings recovery is much closer than the market has priced in. It says the company should also benefit from the next leg of a global aviation recovery. I'd grit my teeth and buy Rolls-Royce shares. Also, Rolls-Royce does have some inflation protection, through long-term sourcing agreements and hedging policies designed to limit raw material price volatility. Flying hours are climbing, too, up 42% in the first 4 months of this year. The cost of living crisis is hitting many people hard, but others still have cash to spend. Rolls-Royce should also be boosted by its defense arm, which now has a massive order backlog as war fears spread. Civil aerospace has a long backlog, too. Its engines are still in demand. So yes, I would grit my teeth and buy Rolls-Royce shares on the current dip. Then I would hold them for what could be a long haul. The market's pointing to this agriculture stock, 40% profits possible. I've been saying for a while now that the way to beat this volatile market is to go back to basics and listen to what the market is telling you, following basic supply and demand, looking for companies that fill imminent market needs, have strong revenue, and enjoy high profit margins. The opportunity I have for you today fills all those criteria, thanks to an unfortunate supply chain problem we're dealing with. We're in the middle of what some are calling a grain crisis. Staple crops like corn and wheat, if farmers can plant them at all, are struggling under severe weather conditions. Canada's Corn Belt, for example, is experiencing an unseasonably hot and dry spring with temperatures reaching 90 degrees Fahrenheit for days on end, while heavy rains and flooding damaged other farms throughout the Dakotas and Minnesota. This, on top of disruptions in Ukraine's growing season due to Russian occupation, has pushed wheat prices through the roof. Wheat per bushel in the United States is now 81% higher than it was this time last May due to increased demand and limited supply. Food inflation will continue to be a problem. Growers that can manage a good crop this year will need all the help they can get to reap maximum yields, and the company I'm recommending today may offer that help. Its tail of the tape is stellar, $21 billion capitalization. Year-over-year revenue growth of 56%. North of $12 billion in revenue in the last 12 months. Like just about everyone else, its stock has taken a bit of a hit recently, and that means it's an ideal time to get in, because I think this one's going to be a fast climber given the current market conditions. This video has the ticker. It's more important than ever for investors to find ways not only to preserve existing capital but position themselves for the best gains when markets recover. As interest rates and volatility rise together, banks are one area where investors are taking refuge. But we've identified two additional key market sectors where a new flood of buying is going to create opportunities for potentially massive profits, especially in small cap stocks that often get overlooked by the major players. I have a strategy to narrow thousands of these stocks down to the few with the biggest potential to be the next market winners. You can get all the details here. Follow Money Morning on Facebook and Twitter. Join the conversation. Click here to jump to comments. About the author. Shah Gilani boasts a financial pedigree unlike any other. He ran his first hedge fund in 1982 from his seat on the floor of the Chicago Board of Options Exchange. When options on the Standard & Poor's 100 began trading on March 11, 1983. Shah worked in the pit as a market maker. The work he did laid the foundation for what would later become the VIX, to this day one of the most widely used indicators worldwide. After leaving Chicago to run the futures and options division of the British banking giant Lloyds TSB, Shah moved up to Roosevelt and Cross Incorporated, an old-line New York boutique firm. There he originated and ran a packaged fixed income trading desk, and established that companies listed in OTC trading desks. Shah founded a second hedge fund in 1999, which he ran until 2003. Shah's vast network of contacts includes the biggest players on Wall Street and in international finance. These contacts give him the real story, when others only get what the investment banks want them to see. Today, as editor of Hyperdrive Portfolio, Shah presents his legion of subscribers with massive profit opportunities that result from paradigm shifts in the way we work, play, and live. The stock market coughed up 17% of its value from January 3 to May 24. That provides investors with an opportunity for a portfolio upgrade. You can sell some stocks with losses, possibly reaping a tax deduction. And you can replace them with good stocks selling for 15% to 30% below their highs. Here are 5 stocks that have been hit hard this year, and are now buys in my judgment. Could they go down further? Of course they could. Catching the exact bottom is a matter of luck. Nonetheless, I feel that you buy these now, you will be glad you did. Based in Santa Clara, California, Applied Materials AMAT is the world's largest supplier of semiconductor manufacturing equipment. The stock peaked in January at about $167. It sells for less than $120 now. Does anyone doubt that semiconductor chips will stay in high demand? Computers, smartphones, appliances and cars are all using more chips, and more advanced chips, as time goes on. While the stock has been smacked, the company is doing fine. Sales rose 28% last year and profits were up 56%. So what ails this stock? As interest rates rise, $1 of earnings in the future, say, in 2029, becomes worth less. So growth stocks have been punished, especially technology. As of May 27, Applied Materials shares sold for 16 times earnings. That seems to me quite a reasonable valuation for a company that has grown its revenue at a 14% annual pace for the past decade, and earnings considerably faster. The largest U.S. home builder, D.R. Horton, DHI, has fallen 29% this year through May 27. The entire home building group has been whacked, and for logical reasons, but I believe the selling has been overdone. What investors fear is that mortgage rates will rise, choking off home buying. It's a rational fear, but it has pounded Horton's price down to 5 times earnings, which is extremely cheap. Home prices have risen a lot in the past 2 years, pricing out some potential buyers. But I think demographics are on the side of the home builders. Millennials are coming of age. Like many of their parents, they may want single-family homes for their children. Horton's return on invested capital has been above 10%, my preferred zone, for 5 years in a row. Selling about 35% below its high is Brunswick BC, which makes boats, outboard motors, fitness equipment and billiards gear. I think investors harbor 2 fears about Brunswick. One is that a recession will come soon, crippling sales of all recreational gear, especially boats. I believe there will be no recession in 2022. The leading economic indicators, designed to be predictive, are still pointing up, and the coincident, real-time, indicators are healthy. The other fear stems from the fact that Brunswick benefited from the pandemic. Boating is outdoor recreation, relatively safe from COVID-19. When the pandemic ebbs, people think Brunswick's profits may tail off. The pandemic probably did help Brunswick, which earned 20% on invested capital last year. But the return was above 10% in 10 of the past 12 years. Target TGT shares fell almost 25% in a single day on May 18. It reported a bad first quarter, as its costs for goods, shipping and labor rose. Like many retailers, it doesn't dare to raise prices commensurately, fearing that shoppers will flee. One of my mantras as an investor is to look for stocks depressed on bad news that is real but temporary. I think Target's troubles fit that description, even though the problems may last for a while. Target has exceeded my target for return on invested capital, 10% or better, in 10 of the past 15 years. I don't expect a recession, but if one should hit, Target is among the better places to be, since consumers trade down to Walmart and Target from pricier stores. Down 31% this year through May 27, MKS Instruments, MKSI, makes instruments and process control systems used in manufacturing semiconductors, flat panel displays, medical devices and other things. MKS, which is based in Andover, Massachusetts, has been profitable in 14 of the past 15 years, and has beaten my return on capital guideline 10 times. Since the company's sales and earnings have been strong lately, I regard the stock as just another casualty of the technology sell-off. At 12 times earnings, I think it's a bargain. Why these 5 semiconductor equipment stocks now have huge potential upside. Over the past 2 years, semiconductor manufacturers and their customers have missed out on some $500 billion in sales because of chip shortages. More than $210 billion was lost in auto sales alone. The good news, according to Deloitte's 2022 Semiconductor Industry Outlook, is that the industry is expected to grow by 10% this year and surpass $600 billion in sales for the first time. Supply chain issues are expected to ease in the second half of the year, although some components could face shortages well into 2023. While well-known mega caps like Intel and Taiwan Semiconductor deservedly get much of the attention in the space, there are small cap and mid cap equipment makers that also have fallen out of favor and, like so many tech stocks, have seen their share prices and ratings slide. Analysts Brian Chin, Patrick Ho and Dennis Piachanin at Stifel recently interviewed executives of several companies operating in the semiconductor manufacturing, process control and test, high-performance computing, and industrial/warehouse automation sectors. These smaller companies operate upstream of the industry's big players and generally reiterated strong short and longer-term outlooks. Based on these conversations, Stifel's analysts think the market may have derated these stocks twice and that when market sentiment reverses, we see an opportunity for a double re-rate, with kickers tied to improving sector as well as stock-specific sentiment. Cohu. Stifel maintained its buy rating on Cohu Incorporated, Nasdaq. Cohu, a maker of semiconductor test equipment that also provides services to chip makers in China, Taiwan, the United States and elsewhere. The company's market cap is around $1.3 billion, and the stock price has dropped by about 25% over the past 12 months. Intel's share price has declined by nearly 32% over the same period. The analysts believe that Cohu is successfully evolving into a higher value supplier to the chip industry and that recent new orders for test equipment are an important sign of the pivot toward a sustainably higher margin/profitability revenue mix, which should help dampen cyclicality as well. The 12-month price target on the stock is $45, which implies upside potential of 64.8%, based on a current price of around $27.30. The stock's 52-week range is $25.06 to $39.86. Form Factor. Form Factor Incorporated, Nasdaq. Form, designs, manufactures and sells a range of electronic testing probes and systems for a variety of semiconductor devices. The company's market cap is around $2.85 billion, and the share price has added about 4.4% over the past 12 months. Since reaching a 52-week high in January, the shares have retreated about 21.5%. The stock is rated a buy by Stifel's analysts. Company management said that its estimated $2 billion serviceable available market for probes in 2023 may happen more quickly due to strengthening customer roadmaps for increasingly complex logic/SoC system on a chip devices utilizing increased levels of advanced heterogeneous die integration. Stifel's analysts noted that the company's customers, including Taiwan Semiconductor and Intel, are moving forward at above expected rates and that regardless of chip sales demand, Form Factor's products are driven more by chip/test complexity, customer yield challenges, and release of new designs. Stifel's 12-month price target is $47, implying upside potential of 28% based on a price of around $36.70. The stock's 52-week range is $32.71 to $47.48. Thanks for watching. Make sure to like and subscribe for more content.